Hello friend and future deep dweller. So now that we are a few episodes in and have started peeling back some of the foundational assumptions in economics and finance, the rational man, the representative agent, we briefly touched on what information is, it feels like time to bring accounting into the mix. Yet another economic fable, but one written in numbers. I thought about how to do that in the same way as the other episode, which, as you know, means starting with the theory or assumption and then looking at the cracks. What happens when we hold it up to the light, what is missing, what does not quite hold up in practice. And it felt natural to connect this one back to the episode about information, because there we ended with a strange observation. Markets often move without any new information, and when they do receive new information, say in the form of a company's quarterly earnings report, they sometimes barely react at all. That seems strange to me. I had grown up with the belief that financial accounting information is what moves markets. So when researchers like Baruch Lev and Fangu point out that earnings and book value together now explain only about 5 to 6% of stock prices, down from around 50% in the 1980s and 90% in the 1950s, that suggested something fundamental had shifted. I needed to see this for myself, so I downloaded historical financial data from Robert Shiller's website, you know, the famous economist at Yale. And if you're interested in the details, you can check out the Deeponomics Substack post on this topic, but the conclusions are that something clearly shifts in the mid-1990s. And I interpret my simple analysis as if investors seem to value accounting information less and less over the years, and that a long-run pattern seems broken. So the last 30 years appear to have redefined the baseline for how markets and investors value corporate fundamentals. In other words, the analysis I did provides a visual echo of what Baruch Lev and Fangu argued, that the connection between financial statements and market valuations has been weakening. Or to be more precise, the difference between the book values in companies' financial reports, which are calculated and determined by accounting standards, have increased in relation to their stock prices or market values, which is what investors think the company is worth. So the ability for book values to explain market values has diminished. So if accounting numbers are not really moving markets anymore, then what are they actually doing? That question opened up a bit of a rabbit hole, because at first I thought the answer might just be markets have changed, companies are different now, more value is tied up in intangibles like software, brands or networks, and those are hard to measure or simply not allowed to be put on the books according to accounting standards. And yes, that is part of it, but the deeper I looked, the more I began to see a different idea. Maybe it's not just that accounting is missing information. Maybe accounting has never really been about just reporting reality. Maybe it has always involved a bit of storytelling. So this is where Ruth Hines comes in. She argued that accounting does not just describe reality, it helps create it. Think about that for a moment. So in her view, when an accountant draws the boundary of what counts as an organization and decides which resources to call assets, they are not just recording facts. They are constructing a version of reality that others then take seriously. So if something is not recognized in the accounts, it can all but disappear. But once it is written down, booked, reported, it becomes part of the company's story. This felt radical when I first read it, but also strangely intuitive, because we do treat accounting numbers as fact. We say a company made this much profits, holds that much in assets, but every one of those figures is the product of a choice, a rule, an estimate, a framework. Anthony Hopwood pointed out that what counts as an expense or an asset is not something you find in nature. It is something society agrees on. And like any social agreement, it reflects certain values and priorities. For example, take staff training. If a company spends $1 million on educating its employee, is that an expense or an investment? So most accounting standards say it is an expense, a hit to this year's profit. But that decision has consequences, right? It shapes how the company is seen by investors, how it sees itself, even how it decides what to do the next time. If accounting makes something look like a cost, we may start to treat it like a cost, even if, in the long run, it adds value. That is one reason why people say accounting is not neutral. It does not just show the world, it highlights some things and hides others. It draws attention to short-term profit, not long-term capacity. It records the money spent on a building as an asset, but not the relationships or knowledge built within it. It treats human capital as a cost and intellectual capital as an afterthought. And that brings us back to the problem Baruch Lev and Feng Gu describe. A lot of what creates value in today's companies simply does not show up in the numbers. We continue relying on financial statements that were designed to measure physical capital, so factories, buildings, and equipment, in an economy increasingly driven by intangible assets like ideas, software, and brands. So physical capital used to be the economic engine of corporate value, but it has steadily declined as a share of market value since the 1980s, and that decline is a reflection of the fact that what drives value today often does not show up on the balance sheet of companies at all. Still, some might say, well, that is fine. Even if accounting is a bit behind, we can still adjust. Analysts know what to look for. Investors read between the lines. But even there, things get murky. Because accounting is not just a reflection of economic activity, it is also a space where choices are made, stories are shaped, and discretion is exercised. Jane Broadbent showed how financial statements are embedded in a broader narrative, so they come with notes, explanations, carefully worded management commentary. Even the numbers themselves can be shaped, not falsified, but shaped through assumptions and judgments. Two honest accountants can come up with two different profit numbers for the same business depending on how they estimate asset lives, bad debts, or inventory flows. And Broadbent went further, suggesting that accounting tends to emphasize certain kind of values, the ones that are quantifiable, hard-edged, and financial, while other values like social or environmental impact often gets pushed to the margins. She described this as a kind of accounting logic that defines what counts as valuable. In other words, accounting is socially constituted and socially constitutive, meaning it is created in a social context and it helps create that context in return. Joni Young looked at how accounting standards themselves are made, so she argued that standard setters do not just observe what users of financial reports need, they help define who the users are. So in her study of US accounting boards in the 1970s, she showed how the investor became the imagined audience for financial reports. That decision shaped which information got prioritized. Other users, employees, customers, the public faded into the background. So even before the numbers are produced, the question of who they are for has already been answered. And that answer shapes the entire system. Michael Power added another layer to this conversation. He looked at how auditing, so the process meant to verify the numbers, actually reinforces the construction of reality. In what he called the audit society, more and more aspects of life are being audited, not just to check them, but to make them auditable. So to be audited, something must first be standardized, made explicit, turned into a format that can be reviewed. And in doing so, the audit process ends up defining what counts as valid performance. And what gets measured gets managed. So what are we left with? Well, on the surface, a financial report looks like a neutral summary of facts. But underneath, it is shaped by definitions, priorities, judgments, and even politics. It tells a story, one that is consistent, rule-based, and formally verified, but still a story. It shows a version of the company, but not the whole picture. Okay, so does this mean we should ignore accounting numbers? Not at all. They are useful, they are required, they provide a shared language for business performance, but perhaps we should read them with more curiosity. What story is being told? What is being left out? What would the picture look like if we included intangibles, or if we saw employees not just as costs, but as sources of value? If information is what reduces uncertainty, as we discussed earlier, then accounting in theory is a tool to provide information. But when the numbers no longer move the market, or when the markets move without the numbers, we are left with a puzzle. maybe the puzzle is not whether the numbers are true or false. Maybe the puzzle is that the numbers tell only one kind of truth and leave out others. Again, I thank you for listening. I hope you enjoyed it. And if you did, please do share it with someone you think would appreciate it. If you want to stay updated when I release new episodes, please hit follow. If you have any questions, reach out to info@deeponomics.com. Take care and stay curious.